There is something in the crypto market where you can make money when prices go up, and you can also make money when prices go down. Sounds like a dream, right? That is futures trading. On the same day, the same coin goes up 10%. A regular spot trader makes 10% profit. A futures trader with the same amount of capital can make 100% profit, sometimes 200%, sometimes even more. Hearing this, you can already see why people love futures, right? Same amount of money invested, but the results can be 10 times different or even more. Coin goes up, you profit. Coin goes down, you still profit. It sounds like striking gold. But hold on, the risk is also 10 times, 20 times, even 100 times higher than regular spot trading. So what exactly are futures? In this short video, I am going to explain it from top to bottom so you can really understand it. What is futures trading? Before diving into futures, to make things easier, I will start with what most of you are already doing, which is spot trading. Spot trading, simply put, is buying and selling coins the regular way. You spend money to buy a coin, that coin goes into your wallet, and you actually own it. When the price goes up, you sell it for a higher price and you make a profit. When the price goes down, you sell it for less than you paid and you take a loss, or you can hold and wait for the price to recover. It is as simple as buying any product. You spend $10,000 to buy 0.1 Bitcoin, then that 0.1 Bitcoin is yours, sitting in your wallet, and nobody can take it away. If Bitcoin's price doubles, your assets double. If the price drops by half, your assets drop by half. That is it. Futures, on the other hand, are completely different. When you trade futures, you are not actually buying any coin. What you are really doing is going to the exchange and placing an order predicting whether Bitcoin's price will go up or whether it will go down. Then if the price moves in the direction you predicted, you make a profit, and if it moves the opposite way, you take a loss. That is all there is to it. These two types of orders in futures have specific names. An order predicting the price will go up is called a long, also referred to as a buy order. An order predicting the price will go down is called a short, also referred to as a sell order. On any exchange you visit, you will see these two buttons, one green and one red. Click long and you are predicting the price goes up. Click short and you are predicting the price goes down. Right direction, you profit. Wrong direction, you lose. Simple as black and white. But why do people call it a futures contract, which sounds so complicated? The name actually comes from traditional financial markets, from long before crypto existed. A futures contract is essentially an agreement between two parties to buy or sell something in the futures, but at a price locked in today. That means no matter how high or low the market price moves over the coming months, both parties still have to complete the transaction at the previously agreed price. This was originally created to help people avoid price volatility risk, especially for commodities like agricultural products, oil, and gold, where unpredictable price swings could bankrupt an entire farm or factory. For example, let's say your family grows coffee and harvest is still a few months away. You are worried prices might crash by then, so you sign a contract with me. You agree to sell me 1 ton of coffee, which is about 2,200 pounds, or roughly 1,000 kilograms, at $4.50 per pound, which is around $10 per kilogram, regardless of where the market price sits at that time. When the deadline comes, if the price has risen to $6 per pound, or about $13 per kilogram, you lose and I gain. If it has dropped to $3 per pound, which is around $7 per kilogram, you gain and I lose. That is a futures contract. Futures in crypto come from the same idea. When you place a long order on Bitcoin at $100,000, essentially you are committing to buy Bitcoin at $100,000. If the price then rises to $120,000, you make $20,000. If it drops to $80,000, you lose $20,000. But that is just the underlying concept. In actual crypto trading, do not picture any physical paper contract and do not expect to wait until any futures date. You just click your mouse to place an order, and after a few minutes of price movement, you will already see profits or losses on your screen. Want to close the position and lock in profits? One more click and you are done. Everything happens within minutes or hours, not months, like the coffee example. In short, trading futures is like predicting the direction of price movement, not actually buying or selling coins. You do not need to have Bitcoin in your wallet to trade futures, you just need money, place an order, and wait for the result. That is also why futures have something very attractive that spot trading does not have. You can make money even when prices fall. In spot trading, when the price drops, you lose. Period. There is no other way around it. But in futures, you get to choose whether to predict the price going up or going down. This is the first key difference between these two trading methods. Leverage in futures. Going back to my earlier question, if futures are just about predicting whether prices go up or down with profit and loss based on percentage price movements, then it sounds the same as spot trading. So what is so special about futures that lets people multiply their accounts by 10 or 100 times? The answer comes from leverage. Leverage, simply put, is when you borrow additional money from the exchange to place orders much larger than your actual capital. On the exchange, you will see numbers like 2x, 5x, 10x, 20x, 50x, 100x, and some exchanges even go up to 150 times. Those are the leverage levels. Choosing 10 times means you are placing an order with 10 times your actual capital. Choosing 100x means 100 times your actual capital. Let me give you a concrete example to make this clearer. Let's say you have $10,000 and Bitcoin is trading at $100,000 per Bitcoin. If you trade spot, your $10,000 buys you exactly 0.1 Bitcoin. After a week, Bitcoin's price rises to $120,000 and your 0.1 Bitcoin is now worth $12,000. You make $2,000 in profit, which is 20%. Not bad at all. Now, with the same amount of money, you trade futures with 10 times leverage. You still put up $10,000 in actual capital, but with 10 times leverage, your order is treated as if you are holding $100,000. That means the exchange lends you an additional $90,000 to place the order, totaling $100,000. With this $100,000, you are holding a position equivalent to one full Bitcoin. When Bitcoin's price rises to $120,000, one Bitcoin is now worth $120,000 and you close your position to take profit. The exchange takes back the $90,000 it loaned you, leaving you with $30,000. So from your initial $10,000, you made $20,000 in profit, which is 200%, 10 times more than spot trading. That is why people love futures and leverage. The same 20% price movement gives you 20% profit on spot, but 200% profit on 10 times leveraged futures. Same wave, same capital, but results that are 10 times different. But hold on. Leverage works in both directions. Same example, still $10,000 in capital, still 10 times leverage. This time, Bitcoin's price does not go up. It drops to $90,000, just a 10% decrease. If you trade spot, your 0.1 Bitcoin is now worth $9,000. You lose $1,000, which is 10%. You still have $9,000 in your account with the chance to hold and wait for the next wave. But with 10 times leveraged futures, you are holding a position equivalent to one Bitcoin worth $100,000. When the price drops to $90,000, your position is also worth $90,000. The exchange takes back exactly the $90,000 it loaned you. How much do you have left? That is right, nothing at all. Your account goes to zero. The same 10% price movement. Spot trading loses 10%, while 10 times leveraged futures wipes out everything, a full 100%. This is the dark side of leverage. Some people multiply their accounts by 10 in a few hours, while others get wiped out in a few minutes. Both are completely real stories. In other words, leverage does not create more money for you, it just magnifies everything. Bigger profits, bigger losses, in the exact ratio you choose. 10 times leverage magnifies profits or losses by 10, 100 times leverage magnifies them by 100. And here's the important point you need to remember. The higher the leverage, the smaller the price movement needed to wipe out your account. With 2 times leverage, the price needs to move 50% against you for liquidation. With 10 times leverage, just 10%. With 20 times leverage, only 5%. And with 100 times leverage, a mere 1% is enough. Bitcoin moving 1% in a few minutes is completely normal. 5% in a single day is also not rare at all. That means when you choose 100 times leverage, all it takes is a small market shake, and within minutes, your account goes to zero. You do not need a market crash, you do not need any major event, just a small price movement going the wrong direction. That is why I always tell newcomers, leverage is not a tool to get rich quick, it is a tool to get wiped out quickly. Experienced traders use low leverage 2 times, 3 times, rarely more than 5 times. Beginners tend to choose 50 times or 100 times because those numbers look so attractive, and they usually blow up their accounts within the first few orders. How to trade futures. Currently, major exchanges like Binance, BuyingKings, and Coinbase all have futures functionality built right into the platform. Anyone interested can check out the links to these exchanges in the video description. The actual process is really simple, just a few steps. The first step is to have an account on the exchange and deposit money into your futures wallet. You can use either a computer or a mobile phone. With a computer, you go straight to the website. On a mobile phone, you should download the app for a more convenient experience. Take note of this. The futures wallet is a separate wallet from the spot wallet. Money in your spot wallet cannot automatically be used for futures. You have to transfer money from your spot wallet to your futures wallet first before you can place orders. Once you have money in your futures wallet, you go to the futures trading interface. There, you will have several things to choose. First, choose the coin you want to trade, like Bitcoin, Ethereum, or any other coin you prefer. Beginners should choose Bitcoin or Ethereum because these two have good liquidity and more stable volatility compared to smaller altcoins. Second, choose your order direction, long if you predict the price will go up, short if you predict it will go down. These two buttons stand out very clearly on the screen, one green and one red. You cannot mistake them. Third, choose your leverage level. The exchange will have a slider or buttons letting you choose 2 times, 5 times, 10 times, 20 times, 50 times, 100 times, and some exchanges go up to 125 times. I will say it again. For beginners, never choose more than 5 times leverage. The best is 2 times or 3 times to get familiar first. Do not look at 100 times leverage on the screen and think it is a way to get rich quick. It is the fastest way to lose everything. Fourth, choose your size, which is how much capital you want to use for this order. If you have $100 in your futures wallet, you do not have to put all $100 into a single order. You can choose $10 or $20 for your first order to get familiar. This amount will be amplified by the leverage you just chose. Fifth, and this is the important part that beginners often skip, set up automatic take profit and stop loss. You set 2 price levels in advance. One level where the order automatically closes for profit when the price hits it, and another level where the order automatically closes to cut losses if the price moves against you. You do not need to sit and watch the screen all day. More importantly, setting stop loss prevents your account from getting wiped out during sudden market moves. This should be mandatory. Anyone who does not set a stop loss is in extreme danger, because you can easily open your screen and find your account at 0. After you finish all the selections, you click Confirm to place the order. The order opens, and your position now appears on the screen, showing your entry price, current profit or loss, and most importantly, the liquidation price. That is the price level where, if the market hits it, your order is automatically closed and your account goes to 0. You look at this number to know how safe your position currently is. If you want to close the order manually at any time, taking profit early or cutting losses early, you just go to your positions, click Close Order. And that is it, as simple as that. The whole process from depositing money to placing your first order takes a beginner about 10 to 15 minutes. The difficulty of futures is not in the mechanics. The exchanges have made it incredibly simple. The difficulty lies in knowing when to place an order, how to size it, what leverage to use, where to cut losses. And the hardest part is having the discipline to stick to your plan when the market does not move the way you expected. If you get liquidated, do you owe the exchange? This is a question I see many people wonder about, so I will answer it right here. The answer is no. When you borrow money from the exchange to use leverage and lose enough to wipe out your account, you do not owe the exchange anything. You do not go negative. The exchange will not call you to demand payment, and they certainly will not show up at your house. The worst case is that your account goes to 0, meaning you lose all the money you deposited, and that is the end of it. The reason lies in the very mechanism of getting wiped out, or in proper terminology, liquidation. Let me explain so you understand why. Recall the earlier example. You have $10,000, you use 10 times leverage, and you place an order with a total value of $100,000, of which $90,000 is borrowed from the exchange. The exchange does not lend to you because they trust you. They lend because they know one thing for certain. They can take their money back at any time before you lose so much that you cannot repay. Here is how it works. When the price moves against your prediction, your order starts losing money. This loss is deducted directly from your $10,000 in capital. Lose $5,000, you have $5,000 left. Lose $8,000, you have $2,000 left. At a certain price level, the loss reaches $10,000, meaning if the exchange closes your order right at that moment and sells the entire position, the proceeds will be exactly $90,000, just enough to repay the exchange's loan. The exchange will close your order immediately without asking for your opinion, take back the full $90,000 they are owed, and leave you with nothing. That is what we call getting wiped out or liquidated. The price level where your order is automatically closed is called the liquidation price. When you place an order on the exchange, this liquidation price appears right on the screen. The exchange calculates it for you. The higher the leverage, the closer the liquidation price sits to your entry price, and just a small market shake is enough to hit it and wipe you out. In other words, the exchange always closes your order before your losses exceed your capital. The exchange will never let that happen because if it did, the exchange would lose money too, and obviously they are not that careless. This is also a major difference between leverage in futures and borrowing in real life. When you borrow from a bank, you owe the bank. When you borrow from the exchange to trade futures, you do not owe the exchange, because the exchange ensures it gets its money back before you blow up. However, there is a small detail you should know. In cases of extreme market volatility, for example when shocking news breaks and the price jumps very deep within seconds before the liquidation order can execute, in theory it is possible for losses to exceed your capital. But all major exchanges today have what is called an insurance fund to cover this gap, and the trader still does not have to pay anything extra. So for individual traders on reputable exchanges, you can rest assured that you will not go into negative balance. And one more point I want to mention right away. In the earlier examples, I calculated profits and losses with very clean, round numbers without including any costs, just to make it easier to visualize. In actual trading, you will have to pay some additional fees. There are trading fees every time you open and close an order, which are usually very small and not significant. But there is one type of fee that beginners often overlook, called the funding fee. This is a small fee that the exchange collects, or sometimes pays you, periodically every few hours while you hold your position, similar to interest on a loan. This amount is usually very small, but if you hold a position for a long time, especially during a hot market, it can add up to a significant number. Final advice. By now, you have a basic understanding of what futures are. Before ending this video, I want to be straight with you, especially those of you thinking about trying futures. Honestly, after almost 8 years of trading crypto, going through many market cycles up and down, I still prioritize spot trading and rarely trade futures. It is not because I do not understand it. It is because I do understand it, and that is exactly why I do not trade it much. Futures are a good tool, but they are a tool meant for people with market experience, with analytical ability, and most importantly, with iron discipline. If you still want to try, I have a few sincere pieces of advice for you. First, only use money you can afford to lose completely. Never touch your living expenses, savings, or borrowed money. Futures can go to zero in a few minutes, and you have to be mentally prepared for that before placing your first order. Second, start with low leverage. 2 times or 3 times is enough to get familiar. Do not look at 100 times leverage on the screen and pick it right away. That is the biggest trap for beginners. Third, always set a stop loss, no exceptions. Fourth, and most importantly, before you trade with real money, take time to observe the market, learn how to read charts, and understand how exchanges work. Do not rush. The crypto market is not going anywhere, and opportunities will always be there. The traders who survive long-term in this market are not the ones who get in earliest, but the ones who get in with enough knowledge and discipline. As for exchanges, you should prioritize the large, reputable ones with high liquidity and a clear operating history, such as Binance, Binx, and Coinbase. The links to these exchanges are in the video description, so anyone interested can take a look. Do not trade on unfamiliar or small no-name exchanges. On those exchanges, the risk is not just from the market, but from the exchange itself. Today's video is just the most basic introduction to futures. There are many other things I have not covered yet, like how to analyze the market, specific strategies, and trading psychology. I will cover those gradually in futures videos. If you found this video helpful, do not forget to subscribe to the channel for upcoming videos. If you have any questions or want me to go deeper into any part, just leave a comment below. See you next time.